Paul Tudor Jones II's 1,987 Black Monday short, how $100 million became $1.1 billion in 3 days. Hi my friends, welcome to ZC's Finance channel. This is the 14th episode of our 5-minute financial series. Last time, we unpacked Dalio's methodical Euro short. Today, we turn to a legend who thrives on market turning points, Paul Tudor Jones II, and his 1,987 Black Monday trade that remains the gold standard for crash timing. What made this trade extraordinary? It wasn't just the 11x return, it was how Jones ignored the bull market hype, used technical analysis to pinpoint the crash to within weeks, and built a $1.5 billion short position, so quietly that no one saw it coming. Let's break down the Elliott Wave details, broker coordination tricks, and panic phase exit rules most summaries gloss over. First, the 90-day pattern hunt that revealed the crash. By July 1987, the S&P 500 had soared 44% in 12 months, with CNBC calling it the forever bull market. But Jones, who'd made his name predicting the 1981 gold crash, dug into 10 years of S&P 500 charts with his team. They focused on Elliott Wave Theory, an approach that divides market moves into 5 upward impulse waves. By August, Jones identified a critical signal. The S&P 500 had completed its 5th impulse wave, peaking at 337.89 on August 25. He paired this with 2 other red flags. 1. The margin debt to GDP ratio hit 2.1%, meaning investors were borrowing record amounts to buy stocks. 2. The Fed had raised the federal funds rate from 5.5% to 7.25% in 5 months, making it harder for companies to service debt. Jones told his traders, the 5th wave is always the most emotional, it's when everyone thinks the market can't fall, that's when it does. Next, the 14-day stealth positioning, to avoid tipping off the market. By early October, Jones was 90% certain the crash would hit by month's end, but a large, sudden short would drive up futures prices and ruin his profits. He used a 3-step plan. Step 1. S&P 500 futures puts. He bought $1 billion worth of November-dated put options on S&P 500 futures, splitting orders across 8 brokers. Each broker got no more than $125 million in orders, and Jones forbade them from using his name, instead labeling trades as institutional hedges. Step 2. Blue-chip stock puts. He targeted 18 overvalued stocks that had risen 50 pence and plus that year. He bought 350 M in puts, focusing on stocks with high short interest ratios. Step 3. Treasury bond longs. To hedge against short-term market rallies, he bought 150 M in 10-year treasury bonds. If stocks rose temporarily, bond gains would offset losses. Then came Black Monday, October 19, 1987. The market opened at 298.95, down 11.5 points. Jones' team monitored 2 metrics, volume spikes and futures spot spreads. By 9:30 a.m., volume hit 100 million shares, and the spread widened to 15 points. Jones knew the crash was in full swing. At 10:15 a.m. the S&P 500 hit 280. He sold 30% of his futures puts, locking in $300 million. By noon, the index had plummeted to 255, and traders were screaming for buyers. Jones waited. He'd preset a rule: sell another 60% only when the S&P 500 hit its 200-day moving average. At 1:45 p.m., it did. He sold the 60%, netting 600 M more. The final rebound play added even more profit. On October 20, the market opened with a 5% rally. He'd kept 10% of his puts to capitalize on this. At 10 a.m., when the rally fizzled, he sold those last puts for $200 million. In total, his $100 million initial investment grew to $1.1 billion in 3 days. Jones later revealed his secret: you don't just short a crash, you plan for every twist. The rebound was predictable because panics always have short-term bounces. We waited for it, then sold again. The trade's legacy? It turned Jones into a Wall Street icon. His fund, Tudor Investment Corporation, gained 205% in 1987, while most funds lost 30 pence plus. More importantly, it proved that technical analysis could predict major crashes, even when the world thought the bull market would never end. Jones's rulebook, follow the waves, hide your positions, and don't greedily hold too long, is still taught in hedge fund training programs today. If you loved this deep dive into Jones' Crash Masterclass, hit like and subscribe. Next episode, episode 15, we're focusing on a trailblazing investor, Judy Shelton, and her 2018 gold versus Bitcoin trade. We'll unpack how she used asset correlation analysis to predict Bitcoin's 83% crash from 19,783 to 3,236, build a $200 million position in physical gold bars and SPDR gold shares, SPDR, and turned a 50M investment into $122 million in 2 years. All while crypto fans mocked gold as old-fashioned. Subscribe now, you won't want to miss how Shelton outsmarted the crypto bubble with a 50-year-old asset. Thank you.